Any doubts? First thing first, you have any doubts? Tell me.
In the corporate sector, in the new scheme, we are telling that 22% tax.
Yes.
But the 22 tax is what amount?
Sorry?
That 22% tax amount will be imposed on the average.
I think you are not understanding. Tax is always on income, never on turnover. One. Two, when you wrote that in the old tax structure, 25% tax rate is for those companies, on the income of those companies whose annual turnover is 400 crores. Tax is never on turnover, it is on income. Any other question? Any other question? I also feel that there is a confusion between understanding surcharge and cess. Am I right? There is a confusion. So I'll remove that confusion also. I told you surcharge is tax on tax. I also told you cess is also tax on tax. Correct? Now I'll give you a simple example. Let us say your annual income is 80 lakhs. And let us say on that income, your tax at the rate of 30% is 24 lakhs. Correct? You are also subjected to a surcharge of 10%. So 10% of 24, 2,40,000, add to your income, tax. Your tax burden will be 26.4 lakhs. Cess will be on this. If there is a surcharge, supposing there is no surcharge and supposing tax on my income is 5 lakhs, right? There will be a 4% surcharge. It is called health and education surcharge. Cess. 4% cess, which is called health and education cess. Because my tax burden is 5 lakhs. Correct? But I am in the bracket where there is no surcharge. Below 50 lakhs. Right? So, on my 5 lakhs of tax, 4% cess shall be imposed, which is called health and education cess. Any other doubt before I proceed further? Because it's always better to first take up doubts of previous year's class. Right? Shall we start? Debate on what? I have already told you, if your income is 80 lakhs and you are in the old tax structure, right, you are subjected to 30% tax, which is 24 lakhs. But then I also told you that since you belong to the old structure, you will avail rebates and concessions. So your tax will not be 24 lakhs. It will be less than that. How much less, you cannot know. Do you understand? In the old structure, there are rebates and concessions. In the new structure, there are no rebates and concessions. That is the reason in the new structure, tax rate is much lower, only 22%. Whereas in the old structure, it is 30%. Very simple. I don't think there is any, there should be any confusion whatsoever. Right? So I think I told you, once we finish corporate tax, I'll also tell you what is MAT, minimum alternate tax. Don't write anything. First, let me explain and let me see how many of you understand. I think I gave you a hint that it was Chidambaran as finance minister who in 1997 introduced what is called MAT, minimum alternate tax. What was the what was the reason? The reason was very simple. There are companies which earn good profits. They earn good profits. And they also declare dividends to shareholders. Correct? And yet, by availing rebates and concessions, they are able to bring down their tax liability substantially. Correct? Now, the government takes a view that if you have brought down your tax liability substantially because of rebates and concessions, right, and yet your profit that you have declared in your balance sheet is high, so you should be subjected to a certain minimum rate of tax. That is why it is called minimum alternate tax. You will not understand unless I give you an example. The example is very simple. Every company has to prepare two accounts. One is called profit and loss account. That means in its books, whether it shows, the board is also here. That is in its books, whether it has earned profits or incurred. Correct? So this will be called book account. Correct? You cannot understand math unless you understand this. Second account a company has to prepare is income tax account for purposes of paying tax. Up to here it's clear? I repeat, every company has to prepare two accounts. One is what is called profit and loss account. That is in its books, it shows whether it has earned profit or incurred loss. The second account it has to prepare is income tax account for purposes of paying tax. Correct? Now, let us say a company has earned 120 crores shown as profit. Okay? Now, by availing rebates and concessions, right? I am putting here rebates and concessions. This road from here to here, it has been able to bring down its tax liability, taxable income to 60 lakhs. I repeat if you have not understood. I said in its books it has shown a profit of, but using rebates and concessions, it has been able to bring down taxable income at 60 lakhs. Up to here it's clear? This 60 lakhs is subjected to 30% corporate tax. Correct? 30% of 60 lakhs would be how much? 18 lakhs. 18 lakhs. Now the government says, if this is less than 15% on this, government will take 15% on this rather than 30% on this. How much does it come? 15% on this? Again 18 lakhs. So let's put it as 130 lakhs. To make things simple. If it is 130 lakhs, it should be 1.3 crores, 120. How much would be? 19. So government will charge 19.5 lakhs rather than 18 lakhs. Which means government says if tax on taxable income at the rate of 30% or 25%, there are two old rates, right, is less than 15% on this, government will take this as the basis and not this. Which means, now I gave you example of Dhirubhai Ambani. Dhirubhai Ambani was a very sharp businessman. Will you believe that he would even show in certain years Reliance Industries as a zero tax company? He was very sharp. So Chidambaram why when I say Damran is a great economist, he understands. If you speak to him, sit down with him for 2 hours, he can answer every question. Unlike Sitaraman. You understand? So try and understand. So he plugged this loophole in 1997 by introducing a tax called minimum alternate tax. When I dictate to you, you should be able to understand that it is a tax imposed at the rate of 15% on such of the companies which earn profits, and yet by using rebates and concessions they are able to bring down their tax liability. Hence the government says that if tax on their taxable income after rebates is less than 15% on book profits, government will take 15% on book profits as the basis for taxation. That is why it is called minimum alternate tax. So please write. MAT is a form of corporate tax. MAT is a form of corporate tax. Which is imposed at the rate of 15%, 15, on book profits of such of the companies, who can open this, of such of the companies which earn profits and by using rebates and concessions comma, they are able to bring down their tax liability. Full stop. Hence, now this is the main sentence. Hence, on such companies MAT is imposed at the rate of 15%, 15, if tax on their taxable income at the statutory corporate tax rate. Statutory means it could be 30, it could be 25. If tax on their taxable income at the statutory corporate tax rate is less than 15% on their book profits. Please read. Please read. I have already explained. Maybe after reading you still have doubt. Please ask me. Yes.
This MAT is imposed like earlier, not now.
No. You should rather say that, sir, that means MAT is imposed only on companies which opt to pay tax in the old structure. So in the new structure, companies which are paying tax in the new structure, there is no question of MAT because they are not using. common sense must be very common. You understand? If common sense is uncommon, you will not understand. Understandably, MAT is not to be imposed on companies which pay tax in the new structure. Because they are not using? Yes. So you can end if there is a confusion. MAT applies only to companies which opt to pay tax under the old structure. You can add that. MAT applies only to companies. MAT applies only to companies which pay tax under the old structure. Simple as that. Yes.
Is there any tax on non-profit companies?
Sorry?
The non-profit companies, is there any tax on that?
Non-profit? My dear, if there is no profit, then where is the tax? Sorry? NGOs. Look, again, why do you call them non-profit? You say that no profit, no loss. Do you understand? These are companies. NGO by definition means they are not working for profits. Do you have an NGO? Are you running an NGO? Then so MAT is nothing but corporate tax on companies which use rebates and concessions to bring down their tax liability, and if tax on their taxable income at the statutory corporate tax rate is less than 15% on book profits. So you have understood the definition of book. Because if I had given book profit without explaining, you would not have understood, sir, what are book profits? Book profits are profits which a company shows in its profit and loss account. Yes.
Sir, according to Finance Act 1987, no company can avoid to pay tax, but at the same time,
No company can avoid.
to pay taxes.
So,
At the same time, there are some companies which are zero tax companies.
correct?
Isn't it a contradictory statement?
Oh, no, not at all a contract. You are talking of 87. My dear, 87 means 36 years gone. So many changes have taken place in the Direct Tax Act. What are you saying? No, you are quoting something which is so old. Total direct tax structure has undergone a change. So, you have done income tax, corporate tax, MAT, also a form of corporate tax. Right? The next is, I gave you a list. Capital gains tax. Just see. Is it capital gains tax? So please write. Capital gains tax. Is a tax which is imposed on capital gains. That is, now you are defining what are capital gains. That is, gains resulting from appreciation in the value of a financial asset or a physical asset over a period of time. Full stop. For example, now example will make things very clear. For example, an investor may buy shares worth 5 lakhs. and sell them within 1 year for 8 lakhs, earning a capital gain of 3 lakhs. Full stop. This amount, which amount? 3 lakhs. This amount shall be subjected to short-term capital gains tax at the rate of 15%, 15%, full stop. However, if he sells these shares for 8 lakhs after 1 year, he will be subjected to long-term capital gains tax. At the rate of 10% over and above rupees 1 lakh. Please read. Over and above rupees 1 lakh. That means up to rupees 1 lakh there is no long-term capital gains tax. Do you understand? That means, in other words, if capital gains in the long run are up to 1 lakh, there shall be no long-term capital gains tax. So I ask you a question. What are shares? Shares are a financial asset. So what we have dictated so far is about financial. Once you have understood this, I'll dictate about physical assets. Please read. शॉर्ट टर्म एंड लॉन्ग टर्म? अरे भाई बोला तो 1 साल तक शॉर्ट टर्म माना जाता है. व्हाट डू यू मीन, क्या मतलब है? लिखवाया मैंने 1 साल तक शॉर्ट टर्म हुआ, बियॉन्ड 1 ईयर लॉन्ग टर्म. Have you not written? If you are selling within 1 year, it is called. If you are selling after 1 year, it is called for financial asset. It may be different for physical asset. Sorry? Better to? Tell it later. Tell what? Sell later. Your friend says it is better to sell it later. That is after 1 year. I want to tell you one thing. In fact, I want to ask you one thing. Are shares meant to be sold over a short period or over a long period? No. If people start selling their shares over a short period, it would spoil the reputation of the company whose shares are being sold. Shares are never meant to be sold. It's a different thing. You are indulging in intraday trading. You are sitting in front of the computer. ये बेचा, ये खरीदा, ये बेचा, making losses or gains. That's a different thing. But by definition, shares are meant to be held for a long period, not for a short period. It's only when you find that a certain share has suddenly jumped, and you are advised by some of your friends, investors and all, oh, straight away buy because tomorrow it's going to fall. That's a different thing. Because there are thousands and thousands of people who sit in front of the computer and do intraday trading, right? That is a different thing. There, they are keeping track of different shares, perfect track. That, oh, yesterday this share was this much, today it is this much. Itna kharida tha maine, aaj bech do. You understand? So this is where you could be making losses, incurring losses or earning gains. Somewhere you may have a gain or strike out balance, whatever. But by definition, by practice, shares are not meant to be sold over a short period of time. And that is the reason when Jaitley reintroduced long-term capital gains tax in 2017 budget, there was huge criticism. Stock markets for a couple of months plunged because there was no long-term capital gains tax prior to 2017. Early 2000 it was introduced but withdrawn. The reason is, but remember one thing, my dear friends, remember one thing. If somebody asks you what is the job of a finance minister, your answer should be to be looking for sectors which are booming so that they can be brought under tax net. For example, in your list of direct taxes which I have given, two taxes that you are now going to do, equalization levy and digital tax, they are imposed on foreign e-commerce companies. Can you deny that foreign e-commerce companies are making a big buck? Yes or no? So, we often say that India's tax base is narrow. We need to broaden the tax base. When you make this statement, obviously what you are trying to say is, as far as possible, bring all those sectors under the tax net which are booming and yet they are out of the tax net. Right? One very prominent example in this case is agriculture. In India, agriculture is out of the tax net. The entire unorganized sector is out of the tax net. And a tax that we will do after this is finished, angel tax. It's coming in newspapers. I'll dictate that also. This is imposed on startups. What kind of startups? I'll tell you. So try and understand that in practice, shares are not meant to be sold over a short period of time. Since they are sold over a long period of time, that means the reputation and image of the company depends on shares held by people. Is that clear? Why go far? A few months back there was Adani in the news. People started mass selling. You understand? The company which superseded Ambani as number one in Southeast Asia dropped. Its ranking dropped tremendously. And I also want to tell you something which is an insider story. It is for you to understand what I am saying. It is the government which has protected Adani. Fall of Adani would have meant so many things, even to the government. I am not detailing it, it's a hard known fact. The kind of interaction we have with the kind of people. You know, the ordinance came on Delhi. Central government issued an ordinance that LG has the power. Ordinance came, the day ordinance came, one day before that I knew ordinance is coming. How? You understand? So there is so much that it goes inside that we as common people don't even know. Withdrawal of 2000 rupee note. Elections are coming. Mainly, that's the only, my dear, in 5 years notes don't get soiled. If that was so, 100 rupee notes, old notes are circulating for the last 26 years. Yes or no? Do away with them. Because mainly big currency notes are used in elections. This is all a part, see, this is all a part of it's a political game. It could be played by any nation, any country. All right? Okay. So, now physical asset. With regard to physical assets, if a person buys a house for 2 crores, house means flat, apartment, whatever, land. If a person buys a house for 2 crores and sells it within 2 years for 3 crores, he may earn a capital gain of 1 crore. Very intelligent. He may earn a capital gain of 1 crore. Full stop. This amount shall be added to his income for that year. And subjected to income tax as per the slab. You understand slab? Correct? Full stop. However, if he sells it for 3 crores after 2 years, it will attract capital gains tax at the rate of 20%. Is that clear? Read. Gold and jewelry, it is 3 years. No, not learn. You see, shall I tell you something? Normally, we are asking about the rate too. We are also, because this 2 years, 3 years would differ. Because take for example shares, it is 1 year. Physical asset is 2 years, right? If you ask me, learn, it may come as a statement. You may be given 4 statements. You may be asked which of them is wrong. Do you understand? That is the way now things are being prepared by way of questions. Now, those 4 statements may be totally different. on different topics in economics, and you are asked to identify which is right and which is wrong. As per the slab, very correct. You bought a house for 2 crores, sold it for 3 crores within 2 years. Correct? The year in which you have sold, that means you have earned 1 crore. Right? That 1 crore is treated as your income. And you know the slab. I gave you the slab. 2.5 to 5, 5 to 10, above 10. So you come, and then I also told you surcharges. That means your income already may be 50 lakhs per annum. Add to it 1 crore. Your income will be 1.5 crores. That is as per the slab. One thing more, which even if you don't write or don't understand, even if you don't write, it's okay. Government says that this 1 crore, that capital gains that you have made, correct? Subjected to 20% tax. This will be on the basis of indexation. What is indexation? Don't write. Not required. Sometimes I feel whether I should be telling you certain things or not. Because if I tell you certain things and you get confused, then problems, right? It's like this. You bought a house for 2 crores. You are selling it for 3 crores after 2 years. Correct? 1 crore is subjected to 20% tax. Government says no. You bought this house for 2 crores 3 years back. What is the price of this house if you were to buy it today? If it is 2.4 crores, then your capital gains are 60 lakhs. Because inflation has also taken place. So indexation means using the price index. I have told you this, it has no meaning as far as your basic understanding is concerned. But government uses indexation to calculate capital gains tax. Okay? So this is another direct tax. Okay? Next. Yes, very sensible question. Supposing you have earned 1 crore as capital gain, but you have used this proceeds to buy another house, then there shall be no capital gains tax. Another thing, you want to avoid paying capital gains tax. You buy capital investment bonds, which have a maturity of 5 years or 7 years. Correct? That also can be used. But then don't forget, when you buy capital investment bond, that money is also going to the government. That was a sensible question. That if you are using the proceeds of that sale to buy another house, then there shall be no capital gains tax. Shall we proceed? Okay. What is the next one? Equalization levy. Equalization levy. Equalization levy. You know, if you have next IAS book, you will see equalization levy is also called GAFA. Google, Apple, Facebook and Amazon. GAFA tax. Right? Anyway. So please write. Oh, yes, I forgot. Securities transaction tax. Please write. Securities transaction tax. Again, who imposed this? Chidambaram, 2005. Don't write. Securities transaction tax is a tax which is imposed on sale and purchase of shares in the stock market. Full stop. For example, I always feel examples are very important for general studies. For example, investor A may sell shares worth 8 lakhs to investor B. Full stop. This amount shall be subjected to securities transaction tax. Which will be shared equally between the buyer and the seller. Let me explain to you if you have not understood. You sell shares of worth 8 lakhs to another person. These 8 lakhs will attract STT. Very, very, very nominal, 0.14%. I can tell you, on 8 lakhs transactions, total STT may come to even less than 5 or 6,000 rupees. This 5 or 6,000 rupees will be shared, half has to be paid by investor A, half by investor B. Now again the same thing which I told you 10 minutes back. Chidambaran introduced securities transaction tax in 2005 because stock market started booming around that time. I'll tell you something more interesting. 1999 to 2004, it was NDA government headed by Vajpayee. Correct? 2004, there were to be general elections. Correct? Jaitley was made election in charge to campaign for the government. Jaitley gave a slogan, India shining. Why? Because for the first time in 2004, Sensex had touched 10,000. 10,000. Today it is 62,000 something. Correct? So it was felt that it is because of that 5 years rule of Vajpayee government that Sensex has gone up. So that slogan was given by Jaitley. Unfortunately, that slogan backfired and government didn't come into power. Sonia Gandhi played a master stroke by bringing in the most uncontroversial man on this earth as Prime Minister, Dr. Manmohan Singh. So, Sensex had started doing well from early 2000. 2004, it had touched 10,000. So, same argument which I gave you. If a sector is booming, it is brought under tax. Tax is very, very marginal. What is tax? 0.14%, hardly. But there is something that is coming. Okay? Yes. Yes, obviously. Correct. Yes. Because that's a very marginal tax. Where? No. Here you are entered into a deal straight away. Correct. Bonds? No, bonds are interest bearing instruments. You understand? What is the difference between a bond and a share? Bond is a loan. If government issues a bond, that means it is taking loan from you. And bond has two features, maturity period and the rate of interest. If bond holder if bond issuer defaults, you can take that bond issuer to the court of law. But when you buy shares of a company, and let's say the company is incurring huge losses, you cannot go to the company and say, here is your share, I don't want. Company will say, get out. Did I ask you to buy my share? You understand? Say yes or no. As even if you are holding one share of a company, you are one of the shareholders of the company. You understand? So bond holder is totally a different concept. Bond is a loan instrument. Right? Limit for what? Limit for? Which transaction? Shares. Like एग्जाम्पल दो. क्या क्या कह रहे हैं? 8 लाख मैंने फिगर बताई भाई. 5 लाख भी हो सकता है, 20 लाख भी हो सकता है, 50 लाख भी हो सकता है. सॉरी, व्हाट इज सेइंग? ओ नो, ऑन एसटीटी. एसटीडी 0.1% लगेगा, अमाउंट कोई लिमिट नहीं है. आपने बेचा है कुछ? So please write. Equalization levy. It is a levy. It is a levy which is imposed at the rate of 6% on annual advertisement income. Annual advertisement income earned by a foreign e-commerce company earned by a foreign e-commerce company from advertisements made on its platform by Indian companies. Full stop. First you read what you have written so far, so that whatever I dictate further you should understand. Read what you have written and tell me what you have understood. An Indian company advertises its products on Amazon. Yes or no? Amazon will charge, right? That income from advertisement is subjected to equalization levy. What is that levy? You are now going to write. Have I made myself clear? Many Indian companies advertise their products on foreign e-commerce companies' platforms. So that advertisement income earned by a foreign e-commerce company is subjected to equalization levy. So please write. For example, an Indian company may advertise its products on the platform of Amazon and pay Amazon rupees 5 lakhs for this advertisement. Full stop. In this case, the Indian company will deduct 6% as equalization levy imposed by the government on advertisement incomes. And it will pay to Amazon. It will pay to Amazon 4,70,000. Full stop. The Indian company will then deposit rupees 30,000. That is 6% of rupees 5 lakhs. You understand? 6% of rupees 5 lakhs as equalization levy with the tax authorities. Read. I made things very simple for you. It's very simple. Right? Okay? Because this is to bring together, Indian companies at par with foreign companies. A. B. This is actually, I am sure some of you sitting here know that there is a proposal to impose 15% global minimum corporate tax on multinational companies. 15% minimum global corporate tax. That means the world community is taking into account this proposal. So once that 15% comes, because you can't deny that Amazon is nothing but a multinational company, but a foreign e-commerce company. Correct? So they are earning this income from Indian companies, right? So this is to be treated as at par with any advertisement income that an Indian company may be subjected to.
Why only advertisement?
That is because separate other income is already subjected to tax. Other income is already subjected to corporate tax.
Why this TDS wala ye picture
No TDS, don't say TDS. It makes things simple. Instead of paying 5 lakhs and then foreign commerce company paying 30,000, the Indian company deducts 30,000 and gives 4.7. You understand? It makes things simple. That Indian company, instead of paying 5 lakhs, is already deducting 6% and paying Amazon 4.7 lakhs. Indian company is then depositing this amount with the tax authorities. So equalization levy is imposed at the rate of 6%. Yes.
Exactly is it equalizing?
Equalizing. No, don't say equalizing. Shall I tell you something? I just now said that foreign e-commerce companies are making a big buck even from advertisements on their platform by a large number of Indian companies. Correct? So this income has to be treated separately apart from their corporate income, which is profits. Right? That is why.
Sir, why can't we tax them at 25 or 30%?
No, again, 25-30% is on their incomes, which is from their operations, selling goods, not advertisement income. That is treated separately, and this will go once there is a global minimum corporate tax imposed at the rate of 15%, because multinational companies are actually in the eyes of, shall I say, a global community for adopting practices to bring down substantially their tax liability. And one such practice is to deliberately route their investments from tax haven countries. So you will understand 15% in the context of 6% as also the last tax, digital tax. When we talk of 15%, you will know, when I take a foreign investment, I'll tell you why there is a proposal which has almost been finalized, that most countries, including India, shall be imposing a 15% minimum global corporate tax, for reasons you will know when I discuss with you the role of multinationals in the context of the tax havens, deliberately routing their investments from countries where tax rates are zero. Vodafone, why go far? Vodafone was subjected to 9,000 crores of penalty by the Indian government. Vodafone challenged this case right up to the Supreme Court, and Vodafone won. Government was humiliated. Government had to withdraw its proposal for retrospective taxation, because 2007 case was Vodafone, where it set up its office in Cayman Island, tax haven, its subsidiary in India. So government took a view that it would have made profit in the past years. So it imposed what is called retrospective tax, right? And it lost the case. And elections were coming. The government withdrew the entire proposal of what is called retrospective tax in its tax structure. All this you will understand when we talk of digital tax or equalization levy. You will understand when I take up minimum global corporate tax, that these taxes will go once there is a minimum global corporate tax at the rate of 15%. Why that proposal is there, you will understand only in the context of practice of multinationals deliberately routing their investment through tax haven countries. Is that clear? So the last tax is digital tax. Please note down. It looks like GST. It is on income. GST is always on sale and purchase. No. Why it is implemented? He talked of TDS. It's almost like TDS. Tax deduction at source. Sorry? Who will say? What is he saying?
If you put tax, then Amazon will start like increasing the value of of the advertisement. So earlier paying 5 lakhs.
Oh no. Please don't take that view. There is always a standard adopted for certain advertisements in terms of what is called. That way you may say you about to buy a commodity from a shopkeeper. 10 days back that commodity was X price, today is X plus 1 price. That can happen anywhere. Why do you think that just because 6% is being deducted, Amazon will start raising its advertisement rates?
But the way, for example, we take an example of
Example of? Next IAS. No, but what is your question on equalization levy? I want to know. This was implemented like GST. GST is an indirect tax. This is a direct tax. You are not selling a good. Are you selling a good? No. It's an income from advertisements. What kind of procedure? Who has implemented? Government. The way they have charged us. How have they charged you? They have charged like any other institute charges. Has Next IS charged in a different way? But it is plus GST. What is the fees you have paid? I don't know. 2 lakhs. That goes to the government. Not plus. 6% on 5 lakhs. Don't say 5 lakhs plus 6%.
They can implement it this way also.
Oh, why should they implement that way? Right. No, don't confuse the two things. No. Why are you saying this should be treated as GST? Then
Similar to GST.
shall I tell you something? When every month you collect some check from, say, Next IS or anybody collecting check from any institute, correct? That check which is given to you is given by first already deducting 10% TDS. You understand? So are you saying that check which is given should be treated as GST? You understand what I am saying? Supposing I get a check of 20 lakhs in a month. I will not get 20 lakhs, I will get 18 lakhs. Listen to me carefully. I will get 18 lakhs, then 18% on 20 lakhs. That is 3 lakh 60,000. The check that I will get would be 2160. Correct? 360 I will deposit before 20th of the next month as GST. You understand what I am saying? You don't understand? The institute has charged you GST, yes or no?
Yes, sir.
Correct? Now, when we get our check because we are providing service. So when I get my check, I have given you example of 20 lakhs, it's like very simple. Straight away, check 20 lakhs per month I am getting. First thing first, it will be 18 lakhs because 10% is deducted as TDS. But since the amount of the check is 20 lakhs, 18% GST on 20 lakhs, the total check that I would get will be 21.6 lakhs. So that by the 20th of the next month, 3.6 lakhs I'll deposit as GST. You understand? Because I'm also providing a service. So I have now clarified your problem. So now relax and enjoy. Now write about the last tax, digital tax. Digital tax is a tax which is imposed on the imposed at the rate of 2%, which is imposed at the rate of 2% on the annual revenue earned by a foreign e-commerce company, earned by a foreign e-commerce company from sale of goods and services, from sale of goods and services in the Indian markets. This tax is imposed on annual revenue above rupees 2 crores. Now read. You are a foreign e-commerce company. You have sold goods in the Indian markets. You have goods and services in Indian markets worth 3 crores. Correct? Now up to 2 crores there is no digital tax. So 1 crore, that over and above 2 crores shall be subjected to 2% digital tax. Both these taxes will be abolished once the world community finally agrees to impose a 15% global, even European countries have this digital tax. In fact, if I remember correctly, Britain was perhaps the first country to impose digital tax. So this is our direct tax structure. I said one last tax, angel tax, because it is in the news. Please write what is angel tax. It is a tax which is imposed on the investment income of instead of writing investment income, put it like this. It is a tax imposed. It is a tax imposed on valuation of shares which may be in excess of the fair market value. Fair market value as determined by the SEBI. As determined by the SEBI, Securities and Exchange Board of India. Full stop. Now I am giving you example to make sure you have understood. For example, a startup company may issue shares to mobilize funds, and the price at which these shares are issued may be higher than the fair market value of these shares as determined by the SEBI. Full stop. Hence, this excess income is subjected to angel tax. You understand? Read what you have written. You are a startup because it is imposed on startups. You are a startup, you want to mobilize funds. You issue shares and what the price at which you are issuing shares is higher than what SEBI determines should be the price. So that excess income that you would have earned is subjected to angel tax. Now you may ask me, sir, why this? There is a feeling by SEBI that a lot of laundered money, unaccounted money may also be invested in some of the startups, right, by some investors. That is the reason. That is why SEBI about 4 days back came out with a statement that sovereign wealth funds, government organizations and such entities which are regulated already in their countries, if they are investing in shares, it will not be taken into account as excess income. So angel tax is imposed on startups in terms of the excess valuation of their shares as determined by the SEBI, which may be in excess of the fair market value. If a share is sold for 10 rupees, if a share is sold for 20 rupees, but SEBI feels its fair market value is 15 rupees. So 5 rupees per share, total income is subjected to what is called angel tax. So this is the direct tax structure. All the taxes that you have, these are all central taxes. States impose only property tax or tax on land, correct? Now indirect tax structure. I said direct tax structure, yes. Correct. Any company can do it. That is the reason. That is the reason that to make sure that any money which may be unaccounted, right? Because it's like saying that a large chunk of investors may have earned some unaccounted money. Why do you talk of Haldiram or any other such? Anything. So the point is, what kind of tax it is? It is on excess income as determined by whom? SEBI. How much percentage? 30%. Flat tax. Right? Tax rate is flat 30%. So give the heading India's indirect tax structure. India's indirect tax structure. Only foreign e-commerce companies. Only. I told you, in some books it is also called GAFA. Google, Apple, Facebook and Amazon tax. Alright? Please write. The center imposes two major indirect taxes. Which are as follows. One, excise duty. And two, custom duty. Also called import and export duty. Import and export duty. All right. Now I am going to explain and dictate what is excise duty and what is. Please write. We are first explaining excise duty. It is a duty which is imposed on goods which are manufactured within the country. Full stop. It has to be paid by the manufacturer before he can take his goods out of the factory premises for sale. Out of the factory premises for sale. Please read what you have written and listen to me carefully. You cannot understand GST unless you first understand excise duty and then understand state level VAT. I repeat, there is no way you can understand GST unless you have understood two taxes. One imposed by the center, which is excise duty, the other imposed by states, which is called value added tax. That is why I am asking you, please read what you have written. You have written something very simple, that excise duty is imposed on goods which are manufactured within the country. Who has to pay it? The manufacturer, before he is allowed to take his goods out of the factory. I am repeating this because this is going to help you understand subsequently. Correct?
The direct tax we wrote that burden can't be shifted. Indirect tax. Indirect tax we wrote that burden can't be shifted. The person on whom it is imposed.
Correct.
He shall pay. So in excise duty also, the manufacturer has to pay. He can't shift the burden.
I want to ask you one thing. You are manufacturing pens. You are subjected to pay excise duty on pens. Correct? Will you not charge it from customers? Will you not add it to your price? What are you saying? Obviously. So please write. I repeat the whole sentence. I said excise duty is imposed on goods manufactured within the country. The second sentence that I gave was, it has to be paid by the manufacturer before he is allowed to take his goods out of the factory premises for sale. Correct? Full stop. Excise duty. Excise duty is called SENVAT. SENVAT. Put a dash. Central Value Added Tax. Because it is imposed on the basis of a value added tax as explained in the following example. So write the example. A shirt manufacturer, a shirt manufacturer may manufacture shirts worth 20 lakhs. A shirt manufacturer may manufacture shirts worth 20 lakhs, for which he may buy and use cloth as an input worth 12 lakhs. Full stop. In this case, the shirt manufacturer is required to pay excise duty, that is SENVAT. That is SENVAT on 8 lakhs, which is underlined from here, which is the difference between the value of the output that is 20 lakhs minus value of inputs, that is 12 lakhs. Full stop. If he is asked to pay, excise duty on 20 lakhs, it will amount to double taxation. Please read it thoroughly and let me see how much you have understood. Read it thoroughly. I repeat, a student who understands excise duty and subsequently understands VAT can easily understand GST. Can you call somebody from there? This event he has to close. It's coming direct on me. Please read thoroughly. Then you are going to ask me questions, I may ask you questions. इसको बंद कर दो, बिल्कुल हवा सामने आ रही. So many of you are feeling, isn't it? So, what have you understood? You have understood? All of you have understood? You have not? You are imagine yourself, you are a shirt manufacturer, factory, correct? You manufacture shirts worth 20 lakhs. To manufacture shirts, which is the major input? Cloth. There are other inputs also, buttons, thread, I am not taking that into account. And you, to manufacture shirts worth 20 lakhs, you buy cloth worth Correct? Now you'll get the answer to his question also, where he was doubting indirect tax. Now I ask you a question. As a shirt manufacturer, will you buy cloth from retail market or from cloth manufacturer? Cloth manufacturer. Because you are a regular shirt manufacturer, you will buy cloth from a cloth manufacturer. Say yes or no. Correct? Cloth manufacturer, while manufacturing cloth, would have paid excise duty. Say yes or no. Excise duty is an indirect tax. He will charge this excise duty from him. Yes or no? So, if cloth shirt manufacturer is asked to pay excise duty on 20 lakhs, he will tell the government, sir, what are you doing? When I bought cloth, I already paid excise duty. So, I should pay excise duty on the difference between the value of the output and the value of the input. That is why, now listen to me, I am giving you the background. Till 1986 in India, I said 86, excise duty was not based on the principle of VAT. It's a value added tax. Advanced countries had already switched over to VAT in 70s. India was a very late starter to introduce value added tax. First time value added tax was introduced was in terms of excise duty. Everything that I am saying has a lot of meaning when we subsequently talk of GST. So when 1986 excise duty was brought under the principle of a value added tax, originally it was called mod VAT. Modified value added tax. Why modified? In this example, what the government will do, it will first tax 20 lakhs. Tell the shirt manufacturer, fill in a pro forma. Indicate in the pro forma the value of the cloth used by you. So that this pro forma will be scrutinized by tax authorities and tax on this shall be refunded. Have I made myself clear? Yes. So it was not that straight away you pay on 8 lakhs. You first pay on 20 lakhs. Came Yashwant Sinha under Vajpayee government in the year 2000. He was finance minister. You know, he stood even for presidency, right? 2000. He said this is nonsense. Irrespective of the, now what was happening from 1986 to 2000? I'll tell you something very easy to understand. You are a shirt manufacturer, right? You have paid tax on 20 lakhs. You are asked to fill a pro forma indicating the value of input, that is 12 lakhs. I ask you a simple question now. Is cloth only of one variety? Cloth itself may have so many varieties. Will you mention the cloth which has higher tax rate or lower tax rate? Higher tax rate. Correct? Now, this was causing litigation. Tax authorities would challenge the cloth, the quality used. The shirt manufacturer will challenge, no sir, you are wrong, I have used this. So neither tax authorities can impose tax, nor he'll be able to. Crores and crores were locked up in litigation. Came Yashwant Sinha, he says, nonsense. This is nonsense, irrespective of the input used. Right? Tax should be imposed on value added. So, that is why it is called SANVAT. Straight away, value added means difference between value of output and input that is subjected to tax. Right? In some of your books, if you find a word called MANVAT, don't get confused. MANVAT means value added tax at the stage of manufacturing. Right? So, you should thoroughly understand one thing now. I repeat, if you understand this, this is first step towards understanding GST. Correct? That in India, excise duty is imposed on goods which are manufactured within the country, A, B, it has to be paid by the manufacturer before he can take his goods out of the factory premises. And C, it is now called, it is based on the principle of a value added tax. Any doubts? Okay. And you should also know, excise duty is imposed by the center, except excise on alcohol and narcotics, which is imposed by states. Yes. Input tax credit. The term ITC will be used in the context of GST because he is getting input tax credit for tax paid on 12 lakhs. 12 lakhs is the input. ITC is the very important term we are using in the context of GST. What is ITC? Input tax credit. That is tax credit for tax paid on input. What is the input here? 12 lakhs. He is getting credit because he has already paid that. Have I answered your question? Any doubts? Now it's no question of refund. Now there's no, because it's straight away on value added. Where is the refund now? Input tax. Under GST, you are asking me to explain things which I have to explain as it is subsequently. Under GST, you pay GST, correct? Input tax credit comes directly into your account. Don't ask me to tell you about GST because I am going to tell you so many things about GST which are going to pleasantly surprise you. Wait patiently. Since you have asked the question, now I am going to tell you. My dear, have you noticed one thing? That every shopkeeper displays his GST number? Was it there earlier? No. After 1st July 2017, when GST came, every shopkeeper displays the GST number. And when GST is to be paid, I am also paying GST. I give you an example. I am paying GST every month, right? If I said 20 lakhs check, 360, supposing it's this month, supposing I have taken a check for June, I will pay 360 before 20th of July, correct? And it is paid by the click of a button. GST is no human interface involved. It's completely online. You have a number, click the button, in seconds you are paying your GST. I don't get input tax credit because I am not using input, but a manufacturer is using inputs. So he pays GST and input tax credit also comes into his account only online. There is no human interface involved in GST. You cannot go to a bank and say, this is my check, I am paying GST. No. There is no question of refund. It is called input tax credit which comes into your account. Everything in online. Yes. किसका? आईटी का रिफंड लेने की जरूरत ही नहीं है. आईटीसी सीधा आपके अकाउंट में आता है. जैसे जीएसटी आप देते हो अपने अकाउंट में से, आईटीसी भी अकाउंट में आता है. यस, यस, एग्जैक्टली. So this is excise duty. Let's take a look what is custom duty. Custom duty. It is a duty imposed on imports as well as exports. Full stop. However, most countries do not impose duty on exports. Most countries do not impose duty on exports because exports become costlier. Exports become costlier and less competitive in global markets. Less competitive in global markets. Full stop. Hence, custom duty generally means import duty. You understand? Generally means import duty, which is of the following three types. Which is of the following three types. 1. Basic custom duty. Basic custom duty. 2. Countervailing duty. We write it like this: COUNTER, countervailing duty. In most books, you also find CVD. When you find CVD, it means countervailing duty. And third, anti-dumping duty. Anti-dumping, DUMPING. So now I am going to explain each of these. First, let's explain what is basic custom duty. Please write. Basic custom duty means that rate of import duty, which is imposed as a standard rate on most of the products imported into a country. This standard rate in India is 10%, which means that basic import duty on most imports is 10%. Please read what you have written. Please read. I want to ask you one thing. On most goods that India may import, the basic rate of import duty is only 10%. Correct? Isn't it very low? No. Now, the explanation for this is WTO. Have you heard of WTO? Yes. World Trade Organization. If I ask you a simple question, Tell me the principal objective of WTO, what will you say?
Maintaining the trade in the world.
Sorry? Sorry? What? My dear, the principal objective is to promote freer trade. What is freer trade? Nations which are members of WTO should reduce their basic import duty. Do you know, prior to the setting up of the WTO in 1995, import duties in India used to touch even 100%. Every member nation of the WTO has to bring down its basic import duty to promote free trade. Southeast Asian countries, they have basic import duty between 5 to 7.5%. America, 15%. It is the WTO's mandate that basic duty should be reduced to promote free trade. Then it's a different thing. Then over and above basic duty, you may impose countervailing duty on specific products. What would be those specific products? You will know only when I dictate what is countervailing duty. So I have only given you the rationale for low import duty because India is a member of the WTO. It chose to become a member of the WTO, which was set up in 1995. Is that clear? Right. So please let's take a look what is countervailing duty. It is a duty which may be imposed over and above the basic custom duty on such of the imported products whose price may be lower than the price of similar domestic product, because of subsidy given by the exporting nation. Full stop. Hence, a CVD may be imposed. CVD, countervailing duty. A CVD may be imposed in order to neutralize the price advantage enjoyed by the imported product and thereby make the domestic product competitive. Now, I am again giving example so that once you read example, full stop. For example, India may import product A from China. Product A from China. And the price of this product may be lower. Than product A manufactured in India. Product A manufactured in India because China would have subsidized. You understand? China would have subsidized its production. Full stop. In this case, India may impose CVD on product imported from China. I have given this example so that with the example you can easily understand. I'll request you read for the next 2-3 minutes. I don't think you'll have any problem. WT has problems with everything. No, it's good. I'm telling you, it's a fact. WT has problem in the subsidies because subsidy is intervention in the free market. I am not teaching WTO, but to share with you, I did a lot of work for the WTO before it was set up. I ask you a question. I am reminded in 2001, America came out with a variety of rice which it called Taxmati and claimed that it is as good as Basmati. It is a fact, I am quoting facts. There was panic in India. What India did? India took the case to the Dispute Settlement Forum of the WTO and dragged America to the Dispute Settlement Body of the WTO for the WTO to adjudicate whether India was right or America was right. And the sole ground on which India challenged this was, guess. India said, Basmati is a geographical monopoly of India. It's a fact. It won the case. Thereafter, you never heard of Taxmati. Remember one thing, the predecessor of the WTO was GATT, 1948, General Agreement on Trade and Tariffs. That was an agreement. There was no dispute settlement body. WTO is a body, right? If there is a body, nations have the privilege to drag any other nation to the dispute settlement body of the WTO, let it decide, right? For example, when I take up this anti-dumping duty, India has imposed anti-dumping duty on some varieties of steel coming from China and South Korea in the last about 2 years back. Now I ask you a question. China can easily drag India to the WTO, or it can retaliate, right? Then it will be left to the dispute settlement body of the WTO whether it favors it favors China or India in terms of its decision or agreement. So, my dear, remember one simple thing. The fact that there is anti-crime law does not mean crimes will not take place. Rather, there will be more. You understand? Anything Any nation can drag any other nation to the dispute settlement body of the WTO. Can you deny that subsidy is intervention in the free market? Yes or no? Can we deny that America continues to subsidize its agriculture in a big way? Green box, blue box, amber box. Somebody who teaches WTO will tell you, right? As I said, I have done a lot of work, right? Who is there, which country is there in the world to challenge America? Developing countries have for years expressed their discontent. But America has disguised its subsidies into green box, blue box and amber box. WTO has not been able to do anything. So try and understand. Your conceptual understanding should be clear that what is at CVD. We are not discussing whether it can be challenged. It can be. I told you. Anything can be challenged. You have imposed anti-dumping duty, the aggrieved nation can take you to the WTO. Is that clear? Now let's take a look at the last custom duty, anti-dumping duty. It is a duty which is imposed to prevent dumping put a dash. Now you are defining what is dumping. A practice whereby a nation, a country, say China, may deliberately sell some of its goods in Indian markets at a price which may be lower than the price at which it may sell these goods in its home markets in order to capture Indian markets. Full stop. This practice is called dumping under the WTO. This practice is called dumping under the WTO. So that aggrieved nation, in this case India, may impose anti-dumping duties. Is that clear? I have made things very clear. And I also given you example. If you read economic survey also and open the chapter, external sector chapter, almost one page every year is devoted to anti-dumping practices. There is a table given. Any nation can drag any other nation to the WTO complaining that this duty has been imposed. But then you have to justify, right? Because any such duty, any anti-dumping duty, you need not write, but we know that WTO says that if you impose anti-dumping duty, it must be lifted, it must be removed if the damage is restored. You can't have anti-dumping duty for years. Do you understand? Some damage has been caused to your, because why have we imposed anti-dumping duty? Because as a result of China selling some of its goods in Indian markets at a price lower than the price at which it would have sold the same very goods in its home markets, it would have led to loss of profits and sales for manufacturing sector for that product, right? And it would cause injury. We call injury, doesn't mean physical injury. So these grounds are the grounds on which you justify imposing anti-dumping duty. I said initially about 2 years back, anti-dumping duty was imposed on some varieties of steel from China. After 6 months, it was also imposed on some varieties of steel coming from South Korea. All right? Such practices go on. Any nation would have the privilege to impose anti-dumping duty, and the other aggrieved nation would have the privilege to drag it to the WTO. We are not discussing that because WTO is a huge forum. Every day there may be complaints. It's like saying you have anti-crime law. Every day there will be complaints. Which is fair and which is not fair is to be decided and determined by its dispute settlement body. All right? So, for all purposes, we have finished 2 major indirect taxes of the center. There's still the third one, GST, which is both center and states. But before we do that, I told you a student who understands excise duty of the center and VAT of states will find it very easy to understand GST. So what we are now going to do is to take up state level VAT, because VAT is the only tax now which states impose, because all other indirect taxes imposed by states have been merged with GST. I give you a simple example. Before GST came on 1st July 17, if you go to see a film, you were subjected to entertainment tax. Now that has been merged with GST. So I have given you, that paper that I have given you, very first point gives you which are the central taxes merged with GST, which are state taxes. I have already given that. So despite practically all state tax, indirect taxes merged with GST, there is still a state tax called VAT, which is still not merged with GST on certain products. Alcohol, yes. So let's take a look. What is VAT? What is state level VAT? Okay, I want to ask, yes. Sorry? किसी कंट्री के साथ? हाँ, वो डिफरेंट है. जहाँ फ्री ट्रेड एग्रीमेंट आ गया ना, उसमें देन यू ले डाउन कि कौन कौन सी चीजें फ्री ट्रेड एग्रीमेंट में आएंगी. हर चीज फ्री ट्रेड एग्रीमेंट में नहीं आती है. टेक फॉर एग्जांपल इंडिया हैविंग ट्राइंग टू हैव फ्री ट्रेड विद ईयू, यूरोपियन यूनियन, फाइनलाइज नहीं हुआ अब तक. आई थिंक आई डोंट नो विच ऑफ माई 2 colleagues is taking up these trade agreements. Is it Professor Vash or Professor Reddy? I don't know. But they'll tell you, because I am quoting one very, very senior economist, Professor Jagdish Bhagwati, who was our esteemed professor in Delhi School of Economics. He says free trade agreements are like spaghetti bowls. Spaghetti bowls, you understand? छोटा बड़ा होता ना खाने में, right? They may be between 2 unequal partners, where I give you a very simple example. India entered into free trade agreement with Thailand. Prior to that agreement, India was having a surplus trade with Thailand. After free trade, it's having a deficit trade. Do you understand what I'm saying? Let's not discuss free trade agreements, because free trade may be कई commodity. सारी commodities free trade में नहीं आती हैं. Remember that. All right? Okay. Give the heading state level. Yes. Sorry? अरे अब तो हर स्टेट करा रहा है, मध्य प्रदेश फलाना. यस, टेल मी. उसमें 100 क्या आएगा? ड्यूटी कहाँ से आ गई? और if ये जो whether it's UP or MP or that southern states, now every state is organizing conclaves to attract foreign investment. Every state. उसमें ड्यूटी कहाँ से आ गई? Most of these conclaves are being organized to attract foreign investment. My dear, you are provoking me to tell you something very interesting. Of the total foreign direct investment that has come into India since 1991, of the total foreign direct investment which has come into India since 91, we opened the economy in 91. Let me tell you, there isn't a bigger reform than what Manmohan Singh did in 91. It required so much of guts to unleash a 40-year-old regime, delicensing, diluting the role of the public sector, opening up for, today you are sitting at $590 billion worth of forex. In 91 it was $1 billion. Nobody recognizes that. The great economist, when 1991, Rao Manmohan model, right, when 91, Narasimha Rao called Manmohan Singh and asked him, I want you to carry out a series of economic reforms because World Bank and IMF have refused to bail us out. Right? Manmohan Singh said one thing, sir, I'll do it. Give me a free hand. I don't want any interference. And at one stroke, who has the guts at one stroke to de-license a large number of industries, substantially dilute the role of the private sector, public sector, open up your economy to foreign investors? आपके $590 billion कहाँ से आ रहे हैं? Not from exports, mainly from FDI and FPI. Where was stock market in India? Foreign investor was not coming to your stock market. You opened your stock market to foreign investors in 93. Whenever your stock market does well, it's predominantly because of foreign portfolio investors. The moment they start pulling out, your stock market plunges. So try and understand that, without any prejudice, I am saying this was the biggest reform ever. Ek stroke mein, it's not easy to do all these. Not easy at all. It was Herculean, I would say. The rest of the reforms are just incremental. If you ask me. Anyway, so we finished central indirect taxes. It's very important for us to understand state level VAT. Yes. अरे कस्टम ड्यूटी तो भाई हमेशा मैन्युफैक्चरर ही देगा ना, या एक्सपोर्टर देगा. चार्ज किससे करेगा? आपसे, क्योंकि इनडायरेक्ट टैक्स है. So that doesn't matter. Your question is different. You are saying whether it is the end user. Remember one thing, my dear. Indirect tax is ultimately paid by the consumer. Simple as that. What is indirect tax? Imposed on someone, paid by? So let's take up, yes. That would depend. That would depend from free trade agreement, from one to another free trade agreement. For example, with Singapore, you have what is called a comprehensive investment and free trade agreement, which is investment also. These are questions which shall be answered by the person or the professor who takes up with you all the free trade agreements, giving you a certain sample. I have told you that it's quite possible that when you enter into a free trade agreement, prior to the agreement you have a surplus trade with that nation. Post agreement you have deficit trade, because it's quite possible goods that you are importing are not the ones where you end up enjoying gaining, whereas goods you are exporting is the one that they are gaining. So it's the other way around. So let's not discuss. These are very complicated issues. They have nothing to do with what we are doing here. That would depend from agreement to agreement. Why is it that it takes years for an agreement to finalize? Because the concerned countries would say, no, we want these all goods also to be a part of the free trade agreement. That is there in common market, it may be without duty. Without duty, because common market means that it is free movement of goods, even free movement of labor. That's a common market. On day one, my dear, if you remember, I recommended to you economics dictionary. Yes or no? Read economics dictionary and you will find what is common, European common market. Easily it tells you everything. Okay? Let's take up state level VAT now. Give the heading state level VAT. Now, I want to ask you one thing, but once I have given you a paragraph on state level VAT, then I am going to ask you a certain question. Please write. State level VAT was introduced. State level VAT was introduced from April 2005. Bringing to an end the age-old regime of sale tax in India. Full stop. State level VAT means that at the stage of sale, there shall be a value added tax from the wholesaler to the retailer to the final consumer. Full stop. The most important virtue of a value added tax is that it minimizes evasion. Because it is mandatory under VAT regime to use bills and invoices at each stage full stop. As such, tax evaded at one stage can be caught at the next stage. due to the use of bills and invoices. Okay, first read. Let me see how much you have understood before I explain things. Okay, let me first explain. Then I'll leave it to you, make things simple for you. Principle of VAT was introduced first when in India? 1986. I told you, yes or no? At what stage? Manufacturing. Correct? I hope all of you sitting here know one thing. Up to the stage of manufacturing, it is the authority of the center. The moment a commodity comes out of the factory for sale in the market, it is the authority of states. Unless you understand this, you will not understand GST. I repeat, up to manufacturing, it is the authority of the center. And I told you, center imposes excise duty, except on alcohol and narcotics. And I also told you, VAT, principle of VAT was first introduced in the respect of excise duty in 1986. Correct? Center wanted that VAT has already been introduced at the stage of manufacturing. It should also be introduced at the stage of sale. Yes or no? Are you understanding? So, answer this question now. VAT came at the state level in 2005. Now answer this question. Prior to 2005, which tax was there at the state level? Sale tax. What was the problem with sale tax? Two problems. One, you buy a commodity from a shopkeeper. The general behavior in India is, shopkeeper will ask you, "Saab, bill chahiye?" Your general reaction is, "Nahi, bill kya karna hai?" Unless of course you have to claim. Correct? The second problem with sale tax. Different states will have different rates of sale tax to attract customers. Say yes or no. So the center wanted that since it had already switched over to VAT for excise duty, state should also adopt VAT at the sale stage. What is the stage of sale? Wholesaler, retailer, correct? So, states, April 2000, I remember there was a paper, it was called State Level VAT, about 40 page, small pamphlet, booklet. The center had set up a committee in 1999. Don't write anything. The reason why I am telling you this is, same modus operandi was adopted by the center to convince states to switch over to GST, to adopt GST. Same modus operandi. 1999, the center set up a committee traveling from state to state to convince states to switch over to VAT, give up sale tax. It took 6 years for that committee to finally convince states. So April 2005, VAT was introduced. And let me tell you, to begin with, only UPA ruled states adopted VAT, because the UPA government was there. As other states found that those states which had adopted VAT were gaining in revenues, they also started switching over to VAT. So, it should be now clear that from 2005 onwards in India, there was a value added tax. VAT at the center up to the stage of manufacturing, VAT at the stage of sale for states. Up to here it's clear? Then I also want you to be clear in your minds that prior to GST, which came on 1st July 17, center collected its own revenue from what? VAT. States collected their own revenue from sale. Say yes or no. Clear? Is it the same thing under GST? No. In GST you are sharing revenue. Say yes or no. When you get a bill for GST, if it is 5% GST, 2.5% CGST, 2.5% SGST. Say yes or no. Unless you understand this, you cannot understand GST. I have laid the foundation for you to understand GST. The foundation is that students must understand that prior to GST, there was SENVAT at the stage of manufacturing, VAT at the stage of sale. Pre-GST regime was, center used to collect its own revenue from manufacturing up to the stage of manufacturing. States used to collect their own revenue at the stage of sale. Clear? Right? And I have told you that the rationale of VAT is what you have written. VAT, the biggest virtue of VAT is it minimizes evasion. How? Very simple. Why go far? I give you a very simple example. This very example, 20 lakhs. This is manufacturing. Same example can apply to sale. You are a manufacturer, you have manufactured output worth 20 lakhs. 12 lakhs worth of input you have used. Unless you are able to show to the government the bill for 12 lakhs. Correct? How can you claim to be paying tax only on 8 lakhs? God forbid there is a random raid on your premises and you are asked to show us. You are paying tax on 8. Show us the bills. Same logic you extend to sale. You are a wholesaler. A retailer buys goods from wholesaler. Retailer buys from wholesaler at 8 rupees, sells at 12 rupees. Pays tax on 4. Correct? In the event of a random raid on his premises, you have been paying tax on 4. Show us your bills. If he fails to do it, he is penalized. That is what you have written. The biggest virtue of VAT is that it minimizes evasion, because tax paid at one stage can be caught at the next stage because of the use of bills. You should have asked me another question. You should have given your argument. Sir, there can be fake bills also. Yes, very recently 10,000 fake receipts have been discovered by GST authorities, amounting to about 22,000 crores. Fake registrations. Electricity bill dikha diya. It came in newspapers. They have claimed input tax credit without using any input. You understand? So try and understand. Nothing is so, there are loopholes to everything. So I have given you the foundation for us to understand what is All India Goods and Services Tax. We will begin by just giving you a small paragraph, but I have a very personal request. I don't know whether you have already read all those 23 points that I gave you on GST. If you have not, make sure that you have read, so that day after when I come, our job is very simple. I will identify for you which are the specific points which you must understand to thoroughly understand GST. We'll discuss it in the class also. But just give the heading now, All India Goods and Services Tax. Please write. All India GST was recommended. All India GST was recommended by Kelkar Committee. Kelkar Committee, K-E-L-K-A-R, Vijay Kelkar was the name. Kelkar Committee, set up in 2004. For the implementation of for the implementation of FRBM Act. FRBM Act, Fiscal Responsibility and Budget Management Act. Fiscal Responsibility and Budget Management Act, because the act came in 2003. Okay? According to this committee, look what this man was saying. According to this committee, an all India GST will mean a revolution, Kranti, a revolution in India's indirect tax structure since independence. Full stop. Such a tax will have several merits as follows. Now these merits I am giving you point, go on giving commas, not 1, 2, 3, 4. Start a fresh para. What are the merits the committee listed? Don't put 1, 2, 3, 4, go on putting commas. It will drastically bring down the cascading burden. Cascading means cumulative. The cascading burden of multiple indirect taxes. Of the center and states, which falls on the final consumer. Comma, reduce prices as a result. Comma, increase consumption and demand. Comma, increase investment and GDP growth rate. Increase investment and GDP growth rate. Comma, increase tax GDP ratio. Increase productivity. Comma, make exports competitive. Comma, bring about uninterrupted movement of goods and services across the nation. Reduce delays. Comma, integrate Indian economy with the rest of the world. reduce delays, comma, integrate Indian economy with the rest of the world, and bring about the ideal scenario of one country, one indirect tax. Do you understand? Now, next time when I come, I would have expected you to have read this. I'll give you the next paragraph where I'll tell you, based on its recommendations, government set up a committee. It is the recommendation of that committee which ultimately was that committee prepared a blue paper which went as a blueprint in the Lok Sabha and Rajya Sabha, and it was passed as a GST bill in the parliament. So the GST Act came in 2016 August, and GST was introduced on 1st July. All this paragraph I'll give you next time, and I expect you to have put question marks on points which you have not understood among those 23 points which I have given you. All right? Day after. All right. Okay.